The biggest investing mistake. Beginners make one of the most common reasons beginners struggle to build wealth in the stock market is not lack of money, but poor behavior during market fluctuations. The single biggest investing mistake most new investors make is trying to time the market instead of staying invested long term. When people first start investing, they often expect the market to move in a straight line upward. However, the US stock market, tracked by benchmarks like the S&P 500, moves in cycles. It rises over time, but it also experiences corrections, crashes, and periods of high volatility. Beginners frequently panic during downturns and sell their investments at the worst possible time. This behavior is called emotional investing, and it destroys long-term returns. For example, when the market drops 10% or 20%, many new investors fear further losses and exit the market. But historically, some of the strongest gains occur shortly after downturns. Missing just a few of the best recovery days can significantly reduce long-term performance. Another version of this mistake is trying to buy the dip or predict the perfect entry point. While it sounds logical, even professional investors struggle to consistently time the market. The reality is that no one can reliably predict short-term movements, not even analysts or fund managers. Instead of timing the market, successful long-term investors focus on time in the market. Studies consistently show that staying invested in diversified assets over long periods produces better results than frequent buying and selling. Index investing through funds tied to the S&P 500 is a popular strategy because it spreads risk across hundreds of companies and reduces reliance on picking individual winners. Another major mistake beginners make is checking their portfolio too often. Constant monitoring increases anxiety and encourages impulsive decisions. Investing should be treated like a long-term wealth-building process, not a daily trading activity. Short-term noise becomes less important when your investment horizon is measured in years or decades. Beginners also tend to chase hot stocks based on social media trends or news headlines. This often leads to buying high after prices have already surged, then selling low when hype fades. This cycle is one of the fastest ways to lose money in the market. A better approach is to follow a disciplined strategy such as dollar-cost averaging, where investors contribute a fixed amount regularly regardless of market conditions. This reduces emotional decision-making and helps smooth out price fluctuations over time. Diversification is another key principle that beginners often overlook. Putting all money into a single stock or sector increases risk significantly. Broad market funds, bonds, and balanced portfolios help reduce volatility and protect against large losses. In summary, the biggest mistake beginners make is reacting emotionally to short-term market movements instead of focusing on long-term discipline. Successful investing is not about predicting the next market move. It is about staying consistent,